Maybe we can start, though, with the macro, because, of course, that's not only what everyone is wondering about and navigating at the moment, what it looks like for private markets in particular. When you think about the changes that we're seeing globally, both in terms of the relationships we're seeing across countries, as well as just the state of macro, interest rate differentials, volatility in markets, perhaps we can get started with you, Huiyang, about how you're navigating that for your clients.
Thank you. So when we look at the private market environment right now, it is a choppy environment with a lot of volatility, uncertainty, especially on the macro front, policy swings, interest rate, as you talk about. How do we navigate in this sort of environment? So at Pictet, where we have been doing private equity investments for the last 35 years, we have always advocated diversification. Diversification across sectors, across geographies, across different asset classes. Stay true to the long-term objective of generating sustainable, attractive investment returns. And by that, we mean really solid value creation operationally. That's a very key factor for us, number one. And number two, to navigate this sort of a challenging environment, one should look at where the mega trends are. So which are the mega trends with a very strong tailwinds, right? So at Pictet, we talk about thematic investments. So we lean into mega trends, like, for instance, technology and innovation. That's pervasive across all end-user markets. So by itself, that's the diversified strategy. We talk about healthcare. Everybody knows, it's aging population. You look at how much is the global health spend. That's estimated to be about 10 trillion, which is easily, a very big percentage of the global GDP. And by the way, out of that 10 trillion, 20% of that is wasted. So clearly there's a lot of inefficiency. It's very dysfunctional, the healthcare system. So when you have situations like that, there's a lot of opportunities that one can look at. I'll just stop here.
So we'll pick up on a lot of that too, but Johan, a lot of people could argue your company, Blue Owl, has been very much in the center of another mega trend, which is that move not just to private equity, but to private credit, to real estate. And Blue Owl has grown tremendously in the last couple of years on the heels of those mega trends. How are those mega trends impacted by the macro volatility of today?
Yeah, thanks a lot, and it's a great question, and thanks for Bloomberg and, of course, Standard Chartered having us here today. It's a great honor. For those of you that don't know Blue Owl that well, we are a 273 billion leading asset manager, but we're also in the forefront of private wealth, which is the subject today. More than 110 billion of our assets under management are actually in the private wealth space. We're also one of the largest credit managers with 140 billion. Direct lending is about 100 billion of the platform. The platform is purpose-built. It's about stability, it's about downside protection, it's about creating a very strong income for clients, which truly works regardless of the market environment. So we feel also that this opportunity is truly an opportunity for private markets in general to showcase and to highlight to wealth clients, family offices, the importance of asset allocation, of having destabilizing assets in your portfolio. So the world is by no means rosy, but when we look through our lens of 400 borrowers on the platform, they are by large growing. They still have single to high single-digit revenue and EBITDA growth. So it's actually quite encouraging. So I believe in the long run, this environment will also show clients the purpose of private markets in their portfolio. It will just help to increase the allocations and the awareness as such.
Implicit in what both of you have said so far is another mega trend, wealth in private markets. Jason, how is wealth management changing the texture of private markets? How is it changing the type of demand and the types of products that are meeting the demand of new investors?
It's definitely a fascinating time. So we see a lot of changes happened in Asia, in private wealth market. So you see the clients here, they are getting more and more mature and sophisticated. If you're talking with them 5 years ago, probably a lot of them, they are chasing after those pre-IPO sort of fast money. But if you talk to those families, high net worth individuals, They were talking about asset allocations. They are more global, and even across different asset class, credit, real estate, secondary buyout, so much more sophisticated. I think according to statistics, around 7 million high net worth individuals from Asia, which is a huge pool of capitals, new type of capitals for private equities. I think in general, if we compare with in US or Europe, let's say this type of investors, they allocate around 15 to 20% to the private equity. Compared with Asia, it's more or less 5 to 10%, which explains why the growth here is 20%. In Hong Kong and Singapore, we see a number more or less. And for example, in Hong Kong alone, you have about 2,700 family office as of now, and they are pretty confident it will be 3,000 family office by the end of the year. That shows how strong this client base is. And on the other side, for the GPs, thanks to the technology development, thanks to the partners with private banks, when they're getting stronger, more local footprint through their platform, we can provide the deal flows, interesting products to those investors. We have been working with many partners, including Standard Chartered banks locally, which has been very successful. I think it's a combination of a lot of the factors which making the Asia private wealth market particularly interesting now.
When you think about the Asia private wealth market, what are you finding most that clients want? Traditionally, that might have been private equity, to your point, or even some of the fast money products, but it seems to be changing in terms of the types of investments that wealthy investors are seeking.
Yeah, so when we look at clients in Asia, for a long time, Asian investors are very familiar and comfortable investing in the stock market, fixed income. So when they want to try something a little bit more complex, like the alternative asset class, they tend to prefer shorter duration solutions, evergreen funds, semi-liquids. I'm sure all of us have heard of that of late. Secondaries is attractive. I'm sure Jason can talk a lot more about that, because there is that hesitation when they hear that, oh, a fund has a term of 10 years. That's a bit a barrier, a mental block, even though private assets is very enticing because it has got the potential for double-digit, very strong returns, but that requires patience. That's suitable for clients with an illiquid pot of wealth.
It's funny, it's hard to have a private markets conversation and not jump right to that hot topic of liquidity these days. Johan, how do you find yourself at Blue Owl changing the types of products you make to meet that demand for liquidity? These are inherently investments that are longer term in nature, yet investors might want the ability to have their money back faster.
Yeah, no, it's a great question. And when Blue Owl started in 2016, we built the private wealth business as a true equal alongside the institutional business. What is truly needed for private wealth to be successful? I always called it 3 ingredients. You need to have the right capabilities. Stable downside protected returns with a high income generation works any given day for private banks, in private wealth, for individual clients. Second one is the accessibility. No matter you have the greatest capability and strategy, if you come in a drawdown format with a 10++, you're eventually not reaching all the clients in the market. So we had our first evergreen strategy since 2017. We have been a pioneer in that segment, and it's eventually a long and a strong component of our business. The third ingredient is having people on the ground. Our clients, our partners, they really need the partnership. They need us to help them bring up the oils penetration in the region significantly. Jason, you mentioned 5 to 10%. From my conversations with some of the leading private banks, we're talking about 3 to 5% on average. In Japan, we're talking about less than 1% of private markets in wealth portfolios. So the opportunity is phenomenal. So we are really talking about the very early stage where there's obviously a lot of room to grow here as well.
I will ask more about how liquid you think this market can really get. But Jason, you and I were kind of joking a little earlier that the word secondary in these markets used to have to come with an explainer after. Now, a lot of people just know what it is because it's gotten so popular. And a lot of that is because of those big institutions needing to sell. Now, how much do wealthy individuals understand the product? How much demand is there now that you are looking at secondary activity pick up so drastically when it comes to the private market universe?
Yeah, so secondary now is getting more and more popular, well known. So I think if you're talking to the high net worth individuals 5 years ago, they will probably consider you a public manager when you say we're doing secondary. But now I think it's quite well known. So basically we're buying the LP portfolios from the big institutions for the liquidity reasons or regulation reasons. And we also sometimes work with GPs to find a solution for their underlying assets. It's quite an exciting moment for Asia as well, because just looking at the Asia asset, there is a liquidity needs. As the statistic shows, again, before 2018, the DPI of Asia funds averagely is about 0.7. If you compare with the average funds in US, in Europe, their DPI before 2018 is about 1.1. So it's lag behind. There's a lot of reasons, and it's not only one country, it's the whole regions. So I won't expand what the reasons, because it's so many reasons behind it. But which means there's a liquidity needs, and for the sellers who own those assets, they're willing to give a relatively deep discount for those good assets. Now, a lot of times, if you these assets will go IPO in the next 6 months, easily you have 2 times return. But they're willing to get a discount, 30, 40% discount, because there's a huge imbalance of buyers and sellers for the Asia assets. So that's for the Asia assets. For the sellers in this region, they are also very active. In the past 7, 8 years, the institutions has building up their private equity portfolios. Now coming to a period of time, they're considered to sort of rebalance in portfolio for various reasons. Sometimes here's the regulation change, denominative factors, geopolitics play a big role nowadays, et cetera, et cetera. So those institutions very actively approaching us and our peers to consider a secondary sale. Given there's also imbalance of demand, the buyers and sellers, so the discount has been interesting as well. And the very good assets, we're talking about global blue chip names, top names, like top 20 names. Yeah, so I think that's also very interesting.
The 30 to 40% number is really interesting to me. For comparisons purposes, Yale is offloading their assets at about a 10% discount. Why is there such a big difference between what you're seeing in the US and Asia?
Yeah, I think, so first of all, the underlying asset is a bit different. So relatively speaking, in Asian portfolio, you still have more growth VC type of investment. Compared with Europe, US, it's mainly buyout. So you have more control. You have good cash flows, which you can predict the cash flows. You can make the models, right? So you need to budget in those uncertainties because of the underlying asset types. It's growth, it's VCs, a lot of them. So naturally, if you're talking, compare with this portfolio, you have a big discount over there. And there's an even bigger imbalance of buyer and sellers for the Asia assets. So very limited capital chasing after those Asia asset secondaries, which, they can have this fortunate, get the luck to pick only the best at a relative quite interesting discount.
Yeah.
Versus in the US, Europe market, you have a lot of secondary players. It's a more mature market, let's put it this way. Yeah.
It's interesting. It gets to another point on the underlying assets. When people think private, they think that the marks don't move around a lot, that there's not volatility based on what else is going on in the world. How do your clients react to that, Liang? Do you find that they are looking for a greater conversation with their managers to see what's going on a regular basis?
So a lot of clients come to us, expressing their interest and desire for secondaries. But investing in secondaries requires a different sort of skill sets because it's about pricing your portfolio. There's always a price for a portfolio, right? If something is going really cheap, big discount, sometimes there's a good reason for it, So familiarity of who the underlying managers are, the GPs, is very, very important. So we have a small secondary business as well at Pictet, but the way we do it is quite different from other bigger platforms. we only buy secondaries bilateral from the existing relationships that we have. Reason being, we are familiar with the GPs. We have underwritten them. We know, what is are they aggressive or are they more conservative when they value the underlying portfolio company, to your point? Because when they say it's, 1.2, should you give 10% discount or should you do a 30% discount? Now, it's not just qualitative, right? It's about peeling the onions, right? And understanding what is inside this portfolio, which are the return drivers in there. And if you are already invested in the GP, you would have been following the underlying portfolio companies, and therefore you can underwrite. It's not about plugging in, your input assumptions into your cash flow modeling, and then it spits out a number. You have to be competitive. And the other thing that I would say is that at Pictet, we don't put on leverage. There are different models for doing secondary transactions. For what we do, because we are on a lot of the LPACs, the advisory committee, so GPs are quite protective about who they allow into their LP list, all right? So whenever, if as an investor you want to sell, you need to get GP consent. And sometimes the GP would rather keep it within their own network of LPs. And us being in the industry for very long, we have cultivated a very deep relationship. It's an easy call, right? They just place a call. You got to be quick, right? Because it doesn't wait too long. So,
Johan, it's really interesting because what I'm hearing here is that there is a lot of transactional activity happening because of the way people are changing what they want to own, very simply. A little bit earlier, you said that downside protection is something that your investors are seeking. Credit, by definition, is less risky than equity. What do you think is driving this much interest in private credit? And you mentioned some numbers around institutional ownership across different parts of Asia. What's going to drive more interest at this point?
Yeah, I think it's the feel very much that is more similar to what clients already experience in their public market portfolios, eventually in their fixed income funds. Some of the evergreen funds, whether it's a BDC, it's a non-traded REIT, it's more the feel of a very stable NAV slow growth type of an income generating product, which they're already used to. So like if I dial back 10 years ago, I used to work with a leading asset wealth manager in the region. We did about 3 to 4 private market deals a year, one credit, maybe one real estate, one private equity, maybe one in secondaries. There's a lot of training going in from the relationship manager population in educating. Again, the format 10 years plus is eventually not too easy. I think the big game changer, in all honesty, were some of these income-generating evergreen products. It started with real estate first. It came with private credit or direct lending next. We see it now in infrastructure. We see it in secondaries coming in. It's the convenience for clients to allocate to these portfolios.
What's the cutting edge of liquidity needs right now? How liquid are these products, and where will they be a year from now?
Rightfully, it started with products where there is natural inherent underlying liquidity as well, like in real estate where you have natural income generation, in credit where you have natural income generation, asset-backed financing, you even have a maturity component of the underlying asset in there as well. I'm not going to make comments on the private equity per se. I leave this to the eye of the beholder on that part. I think secondaries, obviously, you are mitigating J-curve effects as well. And of course, it's also written in the terms. You can subscribe monthly, you can redeem quarterly with a certain limitation in place, which ultimately protects all the existing investor in the portfolios as well. But again, I believe the convenience is a massive game changer because you're reaching a wider audience from relationship managers, from clients that are willing to allocate and to build up an allocation. Drawdown funds still incredibly important. As long as it's differentiated, you have the right strategy meeting the client needs as well.
You know, one of the reasons I was so excited to come to Hong Kong was to see what cross-border investing looked like today. And Jason, you run Greater China for Ardian. What do you think it is that investors in this region, intra-region, really want? Is it to invest more locally? Or are they looking for more opportunities through their fund managers to have exposure abroad, especially given what we're seeing really change underneath the surface in front of us, the changing relationships in the globe?
Yeah, it's a very good question. I think it's very interesting. I think it both ways. You need to be more local, even more local. So it's not like one single largest market you can deploy 80% of your money is that easy. Here, you need to understand this is a region of like 13, 15 big economies, and each different countries have its different investment thesis. You have developed countries which more buyout-driven, carve out from big chapels. You have growing markets, which is exciting with a lot of sort of pre-IPO growth stories, VC, etc. And so different regions, you have different investment themes, and you have a different focus of sectors as well. Say if you're talking about logistics, in some countries, the mainly focusing is the e-commerce growing. So you're putting a lot of e-commerce warehousing, developing project there, versus in some developed countries, it's a lot of IDCs. So even in the logistic, different countries also have very different thesis as well. So that's why you need to be extremely local to monitor those opportunities. So in Asia, it's not like one big economy that give you a narrow spectrum in terms of the risk-return profile. Here, it's much wider spectrum, which is more exciting, but you also more risky. So you can have a fund give you 10 times return, but you also can have a fund which is 0.2, 0.3, which is possible, making the managers who is running on the ground even more important. So the clients need to be very selective who to work with to make sure they have a good local presence, local team to find the best opportunities, best partners in each country to find the good returns. And I would say cross-regional investment is also important because we see also the supply chains. Now it's not only one country, so it's moving around from China, Southeast Asia, Japan. So there's a lot of cooperation there as well. India, Southeast Asia, I think we mentioned there's a lot of corridors here and there. So it's definitely very, very important. And there's investment opportunities there. You see a lot of cross-border success of consumer brands regionally. The AI cross-border collaboration, et cetera, et cetera. I can give a lot of examples of that. So that's also very important. I think so, yeah, both ways.
It's interesting. Over the 2 days, of course, this is my favorite moment of the week, if not the year. My second favorite moment of the week is actually Thursday's U.S. 30-year Treasury bond auction. And of course, it's because people are looking so closely at U.S. assets and the demand for them. Johan, when you talk to clients across Asia, do you find that interest is waning? Are they looking more towards Europe instead, or even more locally? How do you navigate that tension?
No, it's a great question. It's like there is an element of that wholeheartedly. We see that. But one thing I've learned in 19 years being here in this region and affiliated to Wealth, there's first and foremost always a home bias. That's true probably for every market. But other than the home bias, US is a real large overweight in every client's portfolio. And while we see conversation for clients obviously shifting to Europe, and there are definitely great opportunities, Japan, India, other markets, it's literally impossible whether you are focusing on public markets or private markets to ignore the US. So, and one thing I also learned, never bet against the US and never bet against the US dollar in these 19 years here as well. So there is momentarily arguably shift, and from an asset allocation perspective, I think it makes all sense. But when it comes to scalable solutions, when it comes to finding opportunities, again, like truly scalable, which have an inherent element of protection implemented as well, it's hard to ignore the US in all honesty.
I'm going to ask you both this question too, but I'll make Hui Yang really focus on it first. I think this is one of the harder questions because you have India, you have Japan, there's so many areas with so much promise. Which is the favorite among your clients?
In Asia or just globally?
In Asia.
Well, it really depends on where the client is. If you just look at China, right, valuation has come off. Is this actually a good opportunity? But for non-Chinese clients, they may think twice because of exit. It's not quite proven. Challenges in navigating that. When you look at India, I think there's a lot of buzz, there's a lot of startup, a lot of innovation, there's a lot of entrepreneurship. But the exits, well, there has been some exits, but I guess it's not quite very well proven as yet. So to be seen, valuation is also quite intimidating. And when you look at Southeast Asia, I think it's really depending on your cup of tea, right? Southeast Asia, some people say that it's not shallow. Some people think that this is a great opportunity because, you know, on the one hand, people talk about deglobalization. What's the opportunity when you have deglobalization? You talk about regionalization, right? So ASEAN is actually a big opportunity as well. But I just want to extend beyond that. So Johan talked about U.S. Undeniably, U.S., I think it's a very big economy not to be invested in. A lot of clients are overweight there. So clients, some of the clients, we're seeing that, you know, they're thinking about maybe dialing down because they're so overweight in there, right? So where can you dial it down? Well, if you're comfortable in Asia, there's a lot of opportunities, but it's very fragmented. Again, one needs to be careful because the rule of law is not the same everywhere in Asia. And then you have to deal with foreign currency, right? Do you want to hedge? How do you hedge? But I just want to spend a minute about Europe. So Pictet is a European bank, right? So when you look at Europe, interestingly, real estate is getting very attractive, all right? You can now look at real estate properties, opportunities at 30-40% discount, you know, the replacement value compared to a few years ago.
The golden number of the day.
Yeah, and the other thing, it's the divergence, right? We talk about interest rate. Just look at U.S. and Europe, the central bank's policy when it comes to interest rate. ECB has gone the furthest and the quickest, right? With the last cut just 2 days ago is at 2%. U.S. is still hovering at 4.5. I think they want to take a bit more time to figure out whether or not there's going to be inflation impact. So when interest rate goes down, what it means is that you can expect an uplift in your real estate valuation. And the second thing that a lot of people don't quite appreciate is the long-term structural oversupply in Europe, okay? There's too much, undersupply, all right? Because they have very archaic zoning rights permits. As such, it's very difficult to get a permit to build new constructs, new properties. And so there is an undersupply. As such, you wouldn't believe this, right? Just look at London. Do we think London is growing very well despite its attractiveness as a financial hub, right? Last year, it only grew by 1%, but the rental growth for residential was up 11.5%. That's phenomenal. Now, just in contrast, just to finish it off, in contrast, let's take another city in U.S., say Austin. For those of you who have been to Austin, Texas, it's a booming city in a booming state, all right? The unemployment rate is at the lowest, even below the national average. The residential rental has actually plummeted 23%. Why? Because it's overbuilt. So US overbuilds and Europe underbuilds. So explore this opportunity. It's quite an interesting one.
I will confirm we have been spending an enormous amount of time in real estate as well. Jason, you know, just to kind of comment more on where people are going. You talked about the regional opportunities, the diversity of the opportunities. Where is drawing the most interest and why?
You mean the regions or?
And within the regions.
Within Asia?
Within Asia.
Okay. I was about to say Europe otherwise.
I'm going to make you choose your favorite location.
Yeah, so again, I mean, Asia, different countries, they have, you know, present very different opportunities. And different countries, you know, it's all have its exciting opportunities there. So, I mean, if you're looking at to deploy your asset, there's a few very big economies that's where you should probably consider to start with. Of course, China, India, Japan, Korea, Australia. ASEAN is definitely big. Let me just compare in the private equity history. If you just go through the lines, probably, you know, the countries I've mentioned with proven managers, proven exits. So again, I think because it's not one single country, I will be very careful if you putting too much of your allocation into one region, one countries, given there's so much volatility here. So something pan-regionals, pan-Asian, who have the managers, you know, can balance. They have all the teams in different place, but each year they have a different themes, different regions as their priorities. I think it will be better to work with instead of, you know, have double down in one of the countries. If you have high risk, high return profile, some of the countries may be very interesting, very low valuation to start with, or very interesting technologies you want to betting on. But I think as asset managers, I will still be cautious, still aiming for long-term or more steady sort of returns.
Johan, I'll leave you with the final word here because I didn't get to tell you this. I've covered Blue Owl since before it was a billion-dollar company. And so Europe has actually been one of the places that it's been growing a lot. And so to the point that Huiyang and Jason have been making, why, right? I mean, why is it drawing so much interest, especially from investors in Asia? It's easy to see why this year, but why in the long-term sense?
Why in the long-term sense in Europe?
Mm-hmm.
I think, again, I think it comes down to scalability of the market. Clients are arguably quite allocated to the US by now, and you find other large pockets of assets that are scalable, that have downside protection inherently implemented in the business. In Europe as well, you have a healthy direct lending industry, you have a healthy real estate market, you eventually have a healthy secondaries market in Europe. It really shows the signs of scalability where we are investing as a company, arguably and heavily as well.